Thank you everyone for joining our live stream today. As usual, on a monthly basis, we're trying to review the portfolio and also talk a little bit about what's happening in the market. This month has been pretty interesting because we have migrated our main portfolio from Robinhood to Interactive Brokers. So the reason we did that is because there's one key feature that Interactive Brokers and a lot of other larger broker companies offer that Robinhood does not yet have, and that's called portfolio margin. If you're not familiar with it, you have to have an account balance of between $130,000 and $180,000 usually in order to get it. So they don't offer it for the really small accounts, but if you are at a position where you want to use some margin to increase your returns, then definitely recommend checking it out. If you're still new to investing, ignore that. You shouldn't be worrying about margin for years until you're really familiar with how markets move, how risky things are, and then you can consider it to maybe do it in some smaller accounts and only very carefully. All right, speaking about risk management and topics like this, let us do a little bit of a disclaimer. This content is only for educational purposes, so we're not giving any investment advice, tax, legal, or financial advice. You're always responsible for your own investment decisions. We recommend you do your own research and ask qualified financial advisors and professionals for advice. Okay, so let's look at what happened in our Roth IRA over the last month. This is one of our Roth portfolios, the one that we report on online. And the past month actually was pretty good. We are up 22.78% when we compare that with the S&P 500 on the right side. That one was up 8.33%. So our portfolio did a little bit better here, but that goes in both directions. If we looked at March or April, I think February was also more of a down month. And in February, we were down around 20% and the S&P was not down that much. I think it may actually have been flat or down 5. So sometimes you do better than the S&P 500 and sometimes you don't, because the index does have a lot of stability built in. We have something called sector rotation that's happening there. And especially in the beginning of the year, a lot of investors, maybe hedge fund managers as well, they moved funds from the more risky assets into more value-based stocks that don't have as much growth, but they also tend to not lose as much value as the market corrects. And then interestingly, shortly after that, a market correction started to happen, right? So sometimes the large money is giving signals. And in that case, the signal proved out to be one that actually worked out pretty well for them. Okay, and since we didn't do that in the Roth IRA portfolio, we just held on to the companies that we like investing in, like Tesla, like Riot, like SoFi, and a number of others, Rocket mortgage companies. Our portfolio did a little bit of an up and down during that time, but that's okay. We are not looking too much at short-term volatility. We are more interested in long-term portfolio performance. Okay, so maybe we look at what kind of trades we actually did last quarter. Let's see, this is actually one that's not okay. Yeah, this is the one I wanted to share. The other one I think is from a prior month. So we sold calls on Riot, which is a crypto mining / data center company. Their focus is really on mining infrastructure. And they had a bit of a recovery in April, so we decided to sell some covered calls. Previous calls had expired out of the money, so we are ready to sell more covered calls on here. And you can see we collected $124 in credit. That comes from 2 contracts, so about $62 for each contract minus fees. And if we look at return on investment, that's a little bit over 3% ROI. for a time period of, let's say we opened that April 13th, and the expiration was only a week and a half out. So that's actually a great return, right? For just a week and a half, over 3% return. So we were kind of okay with having these shares called away, since we chose a short expiration date there. And then not long after that, April 17th, right, on the 13th, we sold it. On April 17th, we decided, right, it's actually recovering pretty well. Let's roll this up and out. So we added a week of time and we're able to roll it out a whole nother $1, which basically increases the ROI by $100 per contract if we get called away at this level. And that was also a great return, $100 for 1 week of time if we get called away. If not, we just collected an additional, I think it's close to nothing, right? It's just $1 for the roll or less. Yeah, $2 total in credit minus fees. So the rolling credit was not really why we did it, but it's more like we decided either we're gonna hold on to the shares for a little bit longer or we get them called away at a higher price. And May 1st is not that far away. So by end of this week, I think it's end of this week, yeah, end of this week we'll know if we get assigned here or if we can sell more covered calls, hopefully, on this company. That's how the basic options wheel strategy works. If you own the shares, you sell covered calls to kind of collect cash flow on the upper side of the company. And then when you have the cash in your account, you're looking for interesting companies to invest in. So you can sell the cash secured puts on the other side. And speaking of cash secured puts, let's quickly see what kind of market movement we're having so far overnight and see if there's anything interesting we would consider investing in. So honestly, selling cash secured puts right now is a little bit more risky because the market has recovered so much. So we're not doing a ton there. Some companies where I would still consider doing it are companies that have not recovered much, like Tesla would be one of them. And then there's a company called TTD. They're in the advertising industry. They have not recovered much. But of course, those companies, there's also reasons why they haven't recovered much. So it might take a while until we actually see a good recovery there. And the lower the share price, the riskier the investment can also be. So you want to manage your risk there and definitely keep a good margin. Choose companies that you're willing to own in the long term. The mortgage companies and a lot of the financial companies also have not recovered that much. So in that area, SoFi might be a target as well. Robinhood could be a target for potentially doing a cash secured put. And Upstart, it's also mostly loan company as far as I know. Another potential investment target is any company that sells software as a service as their main product. If you believe that they are not totally toast because of AI generated software, if you think that they still have some runway in them and maybe some of them will figure out how to grow even faster with AI generated coding, right? That's something that I see here and there as a potential signal in the industry. Working full-time as a software, as a service company, basically. But that's still a question mark, right? Because we have never been in a period like this. We don't know if AI is fully going to take over and generate very complicated software from scratch anytime soon. Because on the more complicated side of things, you also have to make sure you meet all of the legal compliance requirements. You have to understand your customers really well, so you build something they actually care about. And there's also the aspect of data ownership. Companies that own a lot of data about companies, that's a real asset in itself. None of the AI companies have a similar amount of detailed data that a lot of these large software service companies have. So that's something that could play out positively. And one index that I personally invest in the space is IGV. That holds like a portfolio of different companies. So that's something that I would feel comfortable selling some cash secured puts on with a decent distance, not on a green day, but if we get a little bit of a red day, then it could be one to use. Okay, we're getting closer to market open, but we still got 13 minutes to go. That's it on the trade review here. I want to briefly share about the community that we have. We have some educational content in our Salt Money stock option sales community that I encourage you to check out. The community actually has a free 7-day trial, so you can just go to saltmoneyoptions.com and check it out, watch some of the training content and improve your investment returns by what you learn, hopefully. That's what it looks like when you click on one of the courses. You have the different sections there. You can watch the video, and there are also some tools, some templates and checklists for you to go through and see how you can apply them to your own investment strategies if you like the training content and the strategy. Okay, that's pretty much it for the month and the portfolio update. Let's see if we have any questions that we can address. Of course, a big question that always comes up is what's going to happen with the oil market. And I mean, that's not always a question, but right now it's a big question. Will the Strait of Hormuz eventually be open? How does it affect the stock market? It really looks like, based on the market movements, that the market is ignoring that as a big risk factor right now. It's still a factor when it comes to the oil price, but that's going to affect more of the countries that receive oil from the Middle East. The US, for example, is fairly independent from that oil source. We get a lot of oil from Canada and other areas of the Americas as well as domestically, so oil and gas. So the US stock market seems to be less impacted as long as the risk of a larger war is manageable. That's kind of what matters right now in the perspective of investors mostly. And that's something to keep an eye on. If we have any kind of surprises or big changes there, then we could very easily slip into more of a correction or bull market. And I recommend being positioned in a way where your portfolio can handle that. Either you're prepared for it, you have companies that you own shares or have cash secured puts that if they drop, you're okay with owning those for the long term, even if the price doesn't recover for a while, and to the level of the entry that you bought the shares for, right, with a cash secured put strike price. That's always something to keep in check. And then, of course, more likely than a correction or crash is currently probably a lot of sideways movement with potentially a little bit of a swing higher or more of a recovery for certain areas. I'm watching small caps there. I think we could see more of a recovery there if the market environment continues to look healthy, and if at some point it's more of an expectation that we'll have interest rates lowered sometime later this year. Right now, not a lot of that is being baked in because of the inflation impact of the oil prices. But if we ever get to a point where oil prices will go back to normal and drop again, then I think that could easily shift and trigger more of a risk on movement actually. Okay, let's see that's it. What we wanted to address on questions today. If you have any other questions, feel free to send us a message or comment on any of our social media posts and join us on saltmoneyoptions.com, and we can chat about anything there. Thank you so much for watching,